they said that really LG, so one of the key arguments that was put up by the assessee in case of LG was that, I'm a manufacturer and if I don't do marketing, then I won't be able to do business in India. So whatever product promotion I'm doing, advertisement, is product related and not brand related. So they gave a lot of these examples where they showed newspaper, the DR, the department representative also argued very vehemently on this point. He brought evidences to show that in the newspaper when there was an IPL happening, LG gave an advertisement in the first page of the newspaper which just had LG and it didn't have any other brand, product. So he said that, see, really what we are doing by advertising in all these IPL matches is not any product, but it's the LG brand. So there the argument of the assessee was that, boss, I have a suite of products. And, that's how in our industry one does marketing. So Samsung does marketing or Sony does marketing. And if I don't do it, then, I'll be left behind and my products will not catch up. So, but yeah, I guess, and then interestingly, there was the third member, there was a conflicting view. So LG, there was one member who did not agree to the other two members. And there is a whole discussion in the LG decision about why the third member did not agree, and that's a very interesting discussion. And he said that he discussed about issues of product, where do you draw the line between product and brand promotion? And if there is really an incidental benefit that one gets because of this, is it really a service? And these kind of things, whether it's an international transaction or not. The most ironical thing, in my view, in the case of LG was the decision concluded with saying that the comparables used by the TPO were not appropriate, to calculate the bright line. So it set aside the matter back to the TPO and said that you recompute this. But if one looks at how this international transaction came into the play in the first instance is because of the comparables. So on one hand you are saying that it is an international transaction. On the other hand you are saying that your comparables are not correct. So which means that if your bright line only are not, you believe is not correct, then how is that international transaction only coming into play? So to give an example, if I am incurring an advertisement expenditure of say 7% on sales and my comparables is incurring 3%. So what the TPO said that 4% is my additional transaction. And tribunal said yes, it is additional transaction. But in the conclusion of the tribunal order, tribunal said that this 3% bright line is not correct. So then how is it a transaction? Because that is really what sets my transaction. So I think that it's a very confusing, conflicting decision, though it sets certain principles and all. But then you had BMW that came up. And BMW was a distributor case, not a manufacturer like licensed manufacturer. So BMW distinguished itself saying that LG's facts are of that of a manufacturer. But I am a distributor, and as a distributor my job is to do marketing. So that is a part of my function. And if my profitability is reflecting that margin that my other comparables is reflecting, then I don't need to be compensated over and above anything else. And BMW tribunal said agreed. So in case of BMW, they distinguished the facts with LG, and that is how they came out of this special bench ruling. And then you had Casio. Casio, the facts were similar to BMW, but they said we don't agree to BMW because LG is not applicable only for a manufacturer. LG has laid out certain 14 guiding principles of when this issue comes, and it is important to see those issues in light of Casio's fact, and therefore it set aside the matter back for determining the whole thing afresh. So it's quite a ping pong ball as concerned marketing intangible issue. Another, yeah. No. It's a very rare transaction where one can really prove that the activities that you are doing and the compensation that you are getting is not commensurate to that. So if you see the Glaxo decision and all, the issue was that the benchmarking was done at the gross margin level, and at the net margin level there were not significant profits. So which is why the issue of marketing intangibles, what they said is, so there are two ways in which you could benchmark this activity. One, you could say that, okay, as a distributor of goods where I'm marketing, I get compensated a GP, and then for my marketing activities, I get compensated a cost plus. So then in that case, okay, you can apply the bright line concept. But if I'm following a consolidated model of having a net margin which factors my distribution and marketing function, then I don't need something over and above that. And that is the principle laid internationally. But unfortunately, it is one decision taken. Maruti happened and then the whole series happened. It's like the share valuation trigger that has happened. So I just hope that at least the share value issue, which is the most absurd thing that has happened in the history of transfer pricing worldwide, forget India, is put aside, put to rest.
What is the issue there?
Sorry?
What is the issue?
Share valuation, somebody's covering? So I'll not, it's a very thundering and a very interesting topic. I will not take the benefit away from the presenter. Issue is that I will not tell you what are the outcomes and stuff, but the issue is that Indian company issues shares to its parent company at an X price based on valuation for RBI, and the TPO says your valuation is not correct. Instead of issuing at 12 rupees, you should have issued at 75 rupees. So your share premium should have been that additional amount. And he says that the 75 minus the issue price, the capital receipt that you're getting, should be taxed. So that is the issue. The issue.
Will reopen.
Sorry.
RBI will reopen.
Yeah. Actually, it's the RBI's job. Really. Yeah, you were saying something?
Plus the interest on the loan.
And the secondary issue to that transaction is that the money that you did not receive, that additional, is lying with the parent company. So that is a deemed loan given to the parent company. And you should get an interest on that. It is the paintbrush, the art of imagination of a TPO that the whole nation is trying to defend. Okay, then moving on to the next issue is contract R&D. So contract R&D, again, it's the moot issue is what is the markup? Whether it's a low-end contract R&D, a high-end R&D, what is the risk involved? Whether a profit split should be used. So is the Indian entity one of the basic issues that the TPO has? Is that they believe that what R&D work is being done by India is actually discovery and not R&D. So whatever it's doing is very high-end in nature. And therefore, they should just not be compensated a cost plus, but they should get a share of the profits from the IP generated. And this has been discussed in the UN manual and a lot of other decisions. And subsequent to that, there was a circular issued, which basically spoke about. There was a circular issue which said that in case of contract R&D, you should use profit split method. And then there were certain conditions which were set in that circular. There were certain parameters like if the functions carried out are significant in nature by the Indian entity. Excuse me. Yeah. If the functions carried out by the Indian entity are significant, if the assets are not funded by the parent and they are all self-funded by the Indian company, if there is no supervision and control, if there is a high risk that the Indian entity is taking, and the outcome of the research the Indian entity is able to exploit, then in this situation you are not a captive, but you are a entrepreneur kind of R&D company. And the first circular that came out, said that these conditions should be cumulatively looked at. Then this circular was slightly amended, and because there was a lot of hue and cry after the circular was issued to say that in such a situation it's very difficult to not meet or meet all the 5 conditions. These can be guiding principles to determine your characterization, but you cannot bind the Indian company by these definitions. So then they reworded the circular to say that, these are the principles, and if one of them are kind of there, then, you need to really look at the model. So these were really the conditions. I think it's better to not have the, I realized, first time I'm doing a presentation without a slide, and I felt it was much better. Because it flows much better, you get focused on the slide. So the issue is, in contract R&D is about, the characterization. What is a high-end activity? What is in the value chain of the R&D activities, where does the Indian company fit? Whether you classify under one of these conditions, and if you do, then what is the appropriate method? So the markups that are generally used in case of R&D are to as high as 30-35%. Now you also have a safe harbor that has been announced at 30% for contract R&D. So I guess for pharma it's 29%. So 1% leeway for the pharma industry. CSR, to contribute to the CSR activity. The other interesting issue in pharma is royalty payments. The issue in case of royalty is basically, two kinds of, one is the technical know-how royalty, the other is the brand royalty. And there have been situations where they have disallowed royalty on the context that, you're not able to demonstrate that what is that technology input that the Indian company has got, because according to the TPOs, the formulation, so once you're already paying such a high price for the API, what you're then really doing is just taking that API and formulating it, which is not such a big deal, for which you need to pay a royalty. And the other allegation around royalty, which they've been using in the API context, is to say that your API has an embedded royalty. So in that sense, you are trying to avoid withholding tax implications by increasing your API price. But really that is not in the benefit, because you are paying a higher customs duty also. So these aspects are all interwoven. And if you are incurring a loss, or if you are not able to demonstrate that basically you have received the benefit of that intangible, then they are disallowing it. So one way in which we do royalty benchmarking, there are two ways. Either you can club the royalty with all your transactions and say your TNMM overall profit is arm's length, which they are nowadays starting to reject, because they are saying that your royalty is say 2 crores out of your overall sales of 2000 crores. So how does a TNMM help in demonstrating that royalty is at arm's length? So then in between, you had this leeway when you had these SIA approvals that you used to get, for royalty payouts. You had these rates which were listed on that website, industry-wise, 5%, 8%, 2%. So you could take that and do a cup analysis. But now I think they stopped publishing that, because that limit is gone. There is no, in that sense, a limit available. And the third way to do it is you use databases. So you have royalty source and royalty stat databases, which actually list uncontrolled agreements in industry and in situations. So you actually take those agreements and then do an analysis based on industry and geography and the nature of the IP. Again, it's a very crude way of arriving at a number, because again the IP would differ from agreement to agreement, so it's very difficult. There could be a lump sum value also they could be paying. So how would you justify that? So these are challenges. But one interesting thing at least that has been put to rest by the Delhi High Court in the case of EKL appliances is they say that royalty has got nothing to do with your profit or loss. So the TPO cannot just disallow the royalty because the TPO, one of the allegations in this case the TPO made was that your profitability is not increasing. In fact, you are a loss-making company. So why is there a need to pay royalty? Because that itself shows that there is no benefit derived. So there is no need to pay royalty, was the conclusion by the TPO in this case. So all the appellate authorities agreed disagreed to the TPO and agreed with the taxpayer to say that you can't judge the need of a taxpayer. That is the taxpayer's decision. What you can do is only say that what is the arm's length. You can't say that there is no need for a royalty or there is no requirement. And that is really what has been, confirmed by the Delhi High Court, where they have actually said that the taxpayer only needs to show that the expenditure has been incurred wholly and exclusively for the purposes of business, and the TPO has no authority to disallow the expenditure on the ground that the taxpayer suffered continuous losses. So this is an important decision as far as royalty goes. Then you have the issue of location savings. This is another interesting issue that's come up in the last 1 or 2 years, and it's generally seen in Bombay. I mean, I have not seen in my experience location savings adjustment being done anywhere else in India. It is, in certain 5 or 6 cases where the allegation by the TPO is that ultimately what is location savings? It is that you are doing a particular function in a developed country. Your cost was X and you have relocated that function to India and your cost is X minus something. So the difference in the cost is your savings, and that savings has generated you profits. So who should have a share in the profits is the concern or the issue in case. So the Indian authorities say that, and there is in the UN manual which is published, there is a specific chapter on India which says that the official positions of the tax administrators in India, that's not the CBDT position, but the practice of the tax administrator in India is to say that India should get a share of this location saving. And there is a decision in the case of location savings, which is in the case of Gap International Sourcing. The issue in location savings has 1 or 2 crucial things to understand. When you say location savings, you need to understand that who has the bargaining power in that entire arrangement to negotiate a price. So if you are in a situation where you have a high bargaining power, where you are in a monopolistic situation, where you know that the company who is relocating to India does not have an alternate source, or the industry is not very competitive, is highly uncompetitive in the sense that you have a uniqueness there to come, or you have an intangible which nobody else has, then the Indian company has the bargaining power. And in that situation, one can argue to say that okay, that location saving should be attributed to India. But if you are in a situation where you have a number of comparables and you're one of them, and the parent company who is relocating the function to India has options of relocating to China, Korea, other centers or other players in the Indian industry, then why would he really pass on that profitability to you? Because you will have to quote you'll have to give a competitive price to really win that job, and when you're giving that competitive price, you're not going to negotiate. If it was a third party and you knew that there were 10 other players, you would not actually go and tell the principal company giving you the work to say that, see, you're saving cost by relocating to India, So you give your share of that profit. I mean, you'll never get the job. So that is one issue, the bargaining power issue. The second issue in location savings is whether the profits arising from the location savings at all sit with the parent company. If it is passed on to your end customer, then really there is no issue involved, because then it's gone to a third party. And the whole reason, and 70 to 80% of the times, the companies have outsourced. And why this whole outsourcing model has, initially, when outsourcing started, one had that advantage, so if you were taking that argument in that initial phase, where the profits were getting captured at the parent company and not being passed on to the customer, because the customer was really not aware of the business model. But as and when this outsourcing thing has started picking up, the customers know globally that okay, there is this concept of outsourcing to low-cost sectors. So in customer negotiations itself, customer says that okay, I agree, you can get this done by your India captive or China captive, but because you're getting it done by your India captive or China captive, I want a reduction in the price. So it's a commercial thing now, and it's not mandatory that in all cases the location savings would arise. So this is really the heart and core and issue of the location savings, even in the pharma industry. You have contract R&D, clinical trial, contract manufacturing, all being outsourced to India. And the TPOs are making adjustment in this respect to say that, whatever is the savings, allocate 50-50. So at least they're not taking a position to say everything should come to India. So they're saying 50-50 because manufacturing is also important, R&D is also important, or marketing is also important, manufacturing is also important, depending on, what are the facts. GAP discussed all these issues, and in addition to that, one of the major important things that come out in GAP is it says that the location savings is reflected in the profitability earned by the comparables as well. So ultimately, when you are doing a benchmarking in transfer pricing, you are taking comparables which are in the Indian database, Indian comparables. You are not taking Asian or US comparables. The comparables are also operating in India, and if there is any location savings, then that is also sitting or reflecting in the comparables margin also, because they are in the same location. And this is a very important point, because this brings us to the issue of how this issue really started, location savings. So the issue of location savings started, or the bright idea of location savings came in the mind of one of the officers, was because there was a provision in the Chinese transfer pricing regulations. We sometimes have this habit of comparing with China. And China in their transfer pricing regulations have a calculation which say that to calculate arm's length, you have to calculate what is location rent and advantage, and you have to do that additional attribution to China, and that's it. That is what it is in China, if you want to be arm's length. That's not arm's length, but that is Chinese arm's length. So and there is a reasoning to that. Why they have it is because they don't have Chinese comparables. So they use Asian comparables. So they use, when they do the benchmarking, they accept Singapore comparables, they accept Japan comparables, they accept Australia comparables. Now in that situation, the location is different. So the location savings aspect is not factored in the margin. But in India, it is not the case, So you just can't pick and choose the best and ignore really the basic fundamental of comparables. So that is what GAP International says, and hopefully let's see how this issue goes. I'm sure it will go to High Court, Supreme Court, and I won't be surprised if the law is amended to bring the calculation of location savings. Yeah, sure.
Don't you think application of location savings concept is in substance application of top method in spite of geographical differences?
But there is no geographical difference, right?
No, a US company will pay $100 to a US company, and it is paying $20 to an Indian company.
Correct.
So maybe because of geographical differences, the rates are varying.
Right.
And the department is attributing that difference to location savings.
Yeah, so that is the savings, but whether it should be attributed to India one needs to look at it on the basis that, because let's assume if you go by your cup logic, then what to apply cup, you will have to look at what is another independent service provider in India charging for that. If you are having such a comparable, then you don't need to do an adjustment. But in your example, if you compare yourself with a US cup, then yes, you can do an adjustment. So they are trying to assume, as you're rightly saying, that they're trying to assume that difference, but there is no difference because the comparison is India to India.
How come India to India?
Because when you're doing your benchmarking, you're comparing it with Indian comparables. You're not comparing it with US comparables or Asia comparables or.
But they are saying now that they are paying $100 to other US companies or US employees.
Right.
And in India, the employees are cheap. So they are paying $20 to them.
Yeah, but then if you go by that logic, then the US comparables also have a lower margin as compared to India. So if you take all these services, if you would have gone to a US comparable benchmarking, say for contract manufacturing or for any kind of marketing contract services, you would just give them a 5% margin. You would not give them a 20% margin. So on one hand, you also want a 20% margin, want to compare with India, and on the other hand, you also want to compute the savings. That cannot be done.
And if the department is saying to share 50-50, so in that case, 80 rupees should be divided as to 40 to US company and 40 to the Indian company.
Correct.
So in the next year, US companies will pay 60 rupees. And then department will again say that 40 rupees is the locational savings and distribute 20-20 each to US company as well as to the Indian company.
No, each year the location savings is independent, no? So in the next year, again your operating cost, it's not about only that year. It's a continuing cost. So in the second year, your operating cost will be the operating cost for that year. So you would then still apply 50-50 in that year. And again, so then going by that explanation of 50-50, if you add that 50 to the margin of the Indian company, then his margin will increase from 20% to 30%, which is higher than even entrepreneurial companies operating in India. So what is the logic? I think yes, I agree, there can be an attribution of location savings if you have a unique proposition, if there's really nobody available, if you're doing some high-end KPO activity and no other KPO in India can do it, if you're in that kind of a situation. In fact, if you see some of the case laws that are quoted by the TPO to make this adjustment in their order are international case laws, which is in the case of Sunstrand and Compact, which are Singapore-based case laws, US Singapore. There, what the TPO is trying to say is that the Singapore entity was attributed location savings, but the Singapore entity in the case of Compact, so there was Compact Singapore, who was doing some bit of manufacturing for US, but it was the only player who could in Singapore do that manufacturing. So there were no other manufacturers, and Compact in Singapore had that IP, which is demonstrated through the facts, because of which a location savings was done in that case. So they are also quoting case laws which are actually against them, because the facts of the case are that all these other Indian contract manufacturer, pharma companies, clinical trial companies, there are tens and hundreds of such companies in India, and if you don't code competitively, they will not give it to you. And secondly, are they really parking that profit with themselves, or are they passing on the benefit to the customer? That's also important to understand. So some of the other pharma issues are, that we come across is product analysis versus a basket or a group of products. We have 5:30, right? Time to 5:30. So here, some of the TPOs are saying that you all are okay with continuing till 5:30, right? And when anybody who wants to leave is okay. There is no